Okay guys, so welcome to today's class. So this is the MAC3702 revision class 3 of 3. So this is the final class for the revision program. What I'm going to do, I'm going to cover part C and part D, I think. It is working capital. So we'll work through that now. So I'm going to jump straight into it. We're going to read through the working capital section of the question, and then we're going to answer. We're going to work through answering that particular question. So I'm just going to switch my screen and then we're going to work through it. Okay, so here you should see the screen. So we're going to do part C and part D. So part C says draw up a purchases or production budget in units for EFH for the months of November, December, and January. And then part D says calculate budgeted cash receipts and payments for the months of November, December, and January. Okay, so let's have a look. So remember the first one, one's purchases, but in units, and then the other one, one's cash flows. So cash receipts, cash payments. So there's only one page basically that we need to focus on. So I'm just going to read this one page. So they say EFH debt level, EFH's debt levels have been on the rise in recent years due to a number of internal and external factors which have unfolded over the years. One of the major internal factors cited is poor liquidity management processes. The company has often flouted the budgeting forecasting processes and as a result find itself having to use expensive debt to fund any deficits in its working capital. However, since the IDC bailout application, the management team has implemented more stringent controls around working capital of the company. The statement of financial position on 30th September 2019 had net current assets of approximately 2 billion rand and is made up of the following. So we have inventory, which is 1.5. We have trade and other receivables. We have trade and other payables. We have income tax liabilities. We have cash and cash equivalents, and we have other current assets. They're saying the net current assets exclude the interest-bearing liabilities given in part B above. So they say cash sales average 25% of total sales, and each month's credit sales are invoiced on the last day of the month. Credit sales are also collected as follows. So in there, I'll just take a note. So total sales is 100%. 25% of total sales is cash sales and 75% is credit sales. Any credit sales made in a given month is only invoiced at the end of that month. So if you made credit sales in October, we only invoice those credit sales at 31 October. So just take note of that. So credit sales are collected as follows: 60% within 7 days after the invoice date. So if you made credit sales in October, the invoice is only sent out 31 October. So 7 days from invoice date would be 7th November. So just take note of that. And then 28% by the end of the month after sales. So the first 7 days would be, the first 7 days is November. Then the end of the month after sales. So if it is October, then the 30th of November. Okay, so basically in November, you receive 60% plus a 28%. Okay, so just take note of that. So basically in November, in the month following the sales, you receive 88% of your credit sales. Then they say 9% at the end, 9% by the end of the second month after sales, and 3% is uncollectible. So that means no cash flow for the 3%. So basically your cash receipts will total 97% of credit sales. Okay, so very important. Then they say half of the monthly purchases the company makes is made for in the month of purchase and the remainder in the following month. The number of items of clothing in each month's clothing inventory equals 120% of the next month's units of sales. So very important. So your closing inventory in October, number of units. So your closing inventory units in October is equal to 120% of November's sales. Okay, so important to take note of that. EFH maintains an average product markup of 33% on selling price. The company also expects in the foreseeable future to maintain the existing average cost price per unit as indicated in current net assets above. Okay, so here you can see each item. So the total cost is 1.5, right? If you divide by 6132, you'll get the average cost per unit or per item. They say the actual and budgeted sales of EFH are given below. September, the units, that's the units. October, that is the units. Okay, so this is actual and budgeted sales. Okay, November, which is budgeted, we have budgeted sales. Then we have December budgeted sales, January budgeted sales, and we have February budgeted sales. Okay, but these are all units, so just take note of that. And then they're just saying actual units purchased during October 2019 totaled that amount, 6 million. Okay, so let's have a look what we need to go and do. So we say draw up a purchases budget in units for EFH for the months of November, December, December and January. Okay, so now I must switch over to my Excel or to my Google Sheets, and then we're going to see what do we need. Okay, so remember, what do we want? We need to draw up a purchases budget. So ultimately, we are looking for purchases. So purchases is the unknown, what we're trying to work towards. Okay, so let's have a look. We need production, right? So remember, when you're working with inventory, always just think about the cost of sales formula. When you're working with inventory and you need to work out one of the line items, whether it is units or whether it's in units or in rand value, and you need to either work out opening balance or closing balance or what has been sold or what must be produced, think about the cost of sales formula. So the cost of sales formula says cost of sales equals opening inventory plus purchases. In this case, you replace purchases with production. P is either for purchases or for production. If you're in a retailer like Pick n Pay and so forth, they will use the term purchases. If you're in a manufacturer, because they produce, they will call it production. Okay, so opening balance plus purchases or production minus closing balance. Now, OB is opening inventory, CB is closing inventory, P is for production or purchases, cost of sales is just basically referring to the units sold. Okay, so just take that, just keep that in mind. Or if it's a rand value, then it is the cost of the units that has been sold, not the selling price, but rather the cost of units that have been sold. If you're working in units, then it is the number of units that have been sold. Okay, so very important. So we need, so details, it's December, no, it was November, right? November 2019. Okay, clearly it didn't work. December 2019. Okay, January 20. Now, remember what we want. We want purchases, or we want production. So if I rearrange this equation, basically cost of sales equals, I want purchases alone on one side. So that means OB and CB must come over. So that means an equal to minus, is an equal cost of sales minus OB plus CB will equal purchases. Okay, so you just rearrange that equation. So that means all I can do is as follows. We want units, so we're going to say, remember, cost of sales is units sold. So units sold less opening inventory units, opening units, add closing units. And that will give me my production units. Okay, so that's basically what we're going to fill in. So just take a note, when they're asking you for inventory and they either want you to work out an opening, a closing, or a production, or even the cost of inventory, either in rand value or in units. And if they're giving you different numbers, if they're giving you some of the numbers and you need the other, always just see if you can use the cost of sales formula. Let it run through your mind, see if it's possible. When they want production units, it's basically going to come down to, so when they want cost of sales, either they want sales units or the cost of sales, the rand amount, or if they want production units or the cost of production, this is a good way to have a look at it. Okay, so just take a note of that. Well, the cost of production may be a little bit more complex in the sense that obviously a cost of production is made up of direct material, direct labor, and manufacturing overheads. But from a units point of view or cost or a rand value point of view, see if you can use the cost of sales formula. It generally always works, whether you're in MAC or in FAC. The reason why it generally always work, I'll tell you now why it generally always work. It is because this is like a budgeting type question, right? So when company sets budgets, that's how they work it out. So people are not trying to trick or do something funny. It is just basically how it gets done in the real world. In the real world, when they do a budget, they will estimate sales, right? So the first thing they will do is try to estimate sales, either what they can achieve or what they want to achieve. Okay, so then they will say, okay, this is the sales we expect to make next year. In order to make these sales next year, how many sales do we need? How many items do we need to produce in order to achieve a certain level of sales? How many units do we have to produce? And then how many units they have to produce is a function of the opening inventory and the closing inventory. Some companies have a policy of what the closing inventory needs to be. So now they say, okay, we need to make a certain amount of sales. This is the expected sales balance. We're trying to achieve how much we need to produce. We have a policy of how many closing inventory needs to be on hand. So given the sales that they need to make, given the closing inventory policy, they will say, okay, what is our opening inventory? So remember, opening inventory will generally be an actual number. Because you're at the end of the year, so you know what your actual inventory is. In the real world, they will kind of estimate. They will, based on the time that they are doing the budget, they will have a look, what is my actual closing inventory now? So let's say the year end is 30 December. So they're working out a budget 1 Jan to 31 December. Let's just use it for a full year. In the real world, generally be on a quarterly basis. But let's just say for a full year. So they are in November. They are doing the budget for January. So what they would do, they will take actual closing inventory of October. So having actual closing inventory of October, that's in effect actual opening inventory for November. But now remember, we can't use the opening inventory of November. We need opening inventory of January. Then they'll just say, okay, what do we expect? So we know what actual inventory is. So actual opening inventory is, what do we expect inventory's movement to be in November and December? And they get kind of like an estimated opening inventory for Jan. In an academic world, you are doing here we're doing November, so we have actual October's information. So we will start off with what we know in October to produce everything going forward. So just take note of that. Okay, so that is basically what you need to. That is basically how it gets done in the real world. So because they use that level of thinking in the real world, when they set a paper, they try to mimic the real world as close as possible. It's just us as students don't realize it, right? So like I said, for you guys, it is the advantage you have. Most of you are working, so you can somewhat relate to the real world. So it can make a little bit more sense. But for most people that study full-time, like I was one of those that struggled to try until I forced myself to find a way to actually relate it to the real world. But if you don't relate it to the real world, you're kind of in a vacuum of, just thinking from a theoretical point of view. So just remember, from a budgeting point of view, especially when it comes to units produced, this is generally how they're going to work it out. Okay, it may be a little more sophisticated in the real world, but on a general basis, it'll be something like this. So now we need November, December, January. November, December, and January are all budgeted. We ultimately want to get to production units. So what we're going to do, we're going to fill in whatever we can based on the information provided. So now I'm going to switch back to the scenario, and we're going to try to find out what information do we have, given the fact that we have a framework or a template to fill in. Okay, so that is just some information over there. You can see this information over here was given at 30th September 2019. Okay, we're more interested in October, November, December, and January, because we want November, December, January. So it's best to look for October first, and then we can see how we can make use of September's information. So remember, they're telling you, so this year got to do with production. This section over here has got to do with production. So let's take note. They say half of the monthly purchases the company makes is paid for in the month of purchase, and the remainder in the following month. Now, that sentence is not important to us now. It's important for part D. Part D asks us for cash flow. So that first sentence relates to payment, which is cash flow. We're not interested in payments now. The next sentence says the number of items of clothing in each month's closing inventory equals 120% of the next month's sales. Okay, so that's important to take note. So the number of items of clothing units in each month's clothing inventory equals to 120% of next month's units of sales. Here we're given the units of sales. Okay, so here we're given the units of sales. So just take note of that. We are given the units of sales. So what do we know? The actual sales in November, is 5867, right? So 5867. So we would expect October's closing inventory to be 120% of this. Okay, so we'd expect October's closing balance to be 120% of that. Similarly, now October's closing balance is November's opening balance. Similarly, over here, we would expect December's opening balance. We would expect December's sales to equal to November's. So we would expect November's closing balance to equal 120% of December's sales. Okay, and remember, December's closing balance is equal to November's opening. November's closing balance equal to December's opening balance. Then we would expect December's closing balance to equal 120% of January's sales. Okay, remember, December's closing balance is January's opening balance. We would expect January's closing balance to be 120% of February's sales. So basically, that is what you want to do. Okay, so just keep that in mind. I just want to see something. I'm just going to include October quickly. So let's see what that's going to do. So we don't need October. I just want to insert it. I just want to see why they're giving us that information. October 20. We don't need October. Okay, so I'm just going to highlight it in gray. Going to highlight it in gray. Okay. So remember, opening units is equal to closing unit, the prior month's closing units. Okay, so I made it negative, which is minus. So remember, the units sold is your budgeted sales. Okay, so this is given. Okay, this year equal to prior month closing balance equal to next equal to 120% of next month sales. Okay. Okay, so let's have a look. So remember, what do I need to say now? What do we do now? Yeah. So details. So what we want, we want November's closing balance, right? So November's closing balance, November closing balance. Okay, so November, December. Okay, so closing balance. Okay, so now we can plug in. Now remember, November's closing balance is based on next month's budgeted sales. So November's closing balance is based off December's sales. Okay, so let's have a look. December's sales in units is 6054. Can we just make sure that I use the right number? 6054123. December's closing balance is based on January's sales, so it is 5270. 5270123, and January's closing balance is based on February's sales, 5538. 600. Okay. Then the percentage is 120%, so it's 1.2. You can make it 120%, doesn't matter. 1.2, 1.2. So therefore my closing balance must be that multiplied by 1.2. So our closing balance has to be that. Okay, so that my closing balance has to be, and we're going to say it is working 1. Okay, so now we can plug in units sold. We will use the actual units sold of the month. So the budget for November is 5876. 5876. 5876. What was it? 500. 5876 500. Let me just check. Yep. Then December sales is December sales. That. And that would be January sales would be the 5270. Okay, so that is basically it. All we need to do is to get October's closing balance. Okay, I just want to see quickly what they just did over here. So I want to have a look at something quickly. So they're telling us that actual production, actual units purchased during October total 6029. Okay. want to see quickly something. So for October, I just want to see October's information. Was maybe October's closing balance is different. So that's what you need to just check. So working 2, we need October's closing balance so there can be November's opening balance, right? I just want to see if it's not going to equal to 120% of November's sales. So I'm going to do 2 checks because I want to see why they're giving me this information. I want to know why are they giving me that information. I wouldn't expect that information given they gave me all of this and they gave me all of this. I don't know why they're giving me this actual units purchased during October. So I want to do 2 checks to see if an answer comes to be the same. So one way is we want to work out the closing balance of, October. So if you rearrange this equation, so remember cost of sales equals opening inventory plus purchases minus closing balance. So I want closing balance. So if I want closing balance, basically if I take closing balance to the other side of the equation, closing balance equals opening balance plus purchases minus cost of sales. Okay, so I'm just using that formula. So if I put it over here, opening balance, purchases, cost of sales, and I get closing balance, that's what I want. I just want to check something. So remember, the formula says opening balance plus purchases minus cost of sales equals opening balance, equals closing balance, okay? So they gave me the purchases, so I must take that. They gave it to me. 6029,800. 6029,800. So they gave me that. I know what they are selling. October's actual sales was 5110. 5110. 5110,000. Okay. October's opening balance would be equal to October's opening balance would equal to September's closing balance. September's closing balance would have been 120% of October's sales. Okay, so we're going to say October's sales, which is 510123 times 1.2. So that's the answer we get over there. So so what I'm just doing, I just want to check if we get to the same answer. Because if we get to a different answer, then I want to tell you which answer you need to choose. So this is just some stuff you need to be aware of. So remember, in October, the actual units sold is 510123. The opening units of October would have just basically equaled the negative of this. It's the same thing of September. Remember, opening inventory is last month's closing inventory. Now, September's closing inventory would have been 50%, would have been 120 of October's sales. Okay, so it's just the same thing over there. Then closing inventory, if we use the formula, closing inventory must equal to 120% of November's sales. So if I just say equal November's sales multiplied by 1.2, yes, okay, so it comes out to be the same. So if I just say equal sum, okay, so you can see production unit 6029, and they also told us actual production was 6029. I just wanted to do a check because I wanted to know why did they give it to me. there was no need for them to give it to me because I'm going to work it out anyway. So basically, units to be produced each month would be as follows. So I just wanted to show you, this is the way I would have calculated October's closing inventory. Okay, because we need October's closing inventory to get November's opening inventory. So this is how I would have calculated it as per normal. But they gave me, so what threw me off a little bit, they gave me production units. Now I want to know, why did they give me production units? So all I just went to go do, I went to work out the fact that they're giving me production units. Let me work out the closing inventory because I want to see where it's going to differ. As you can see by me just rearranging the equation to work out a different number, with the fact that they gave me production units, I'm not calculating production units. You can see we're coming up to the exact same answers. So there was no need for them to actually give me the production units of October. I just need to check for myself because why I'm aware of this is that in a CTA exam, although they gave me the information to tell me that closing inventory is 1.2 of next month's sales. So if they gave me that, there was no need for them to tell me that production units is 6029 for October. So the fact that they gave it to me, in my mind, what goes through my mind is that there's probably something different happening in October. That will happen. That's generally what CTA would do. So although the rule is closing inventory is 120 of next month's sales, because of that rule, I don't expect them to give me any production units. Okay, so I don't expect them to give me any production units. I can work it out. By the fact that they did give me production units just for October, which is based on actual information. So remember, November is all budgeted. So because it's all budgeted, it will follow the policy that closing inventory is 120 of next month's sales. Now I know October is actual information. Now, because they gave me the actual production for October, what goes through my mind is that perhaps in October, the actual information did not turn out to be as expected. And that is why I just did both calculations to see if there is any difference. If there's no difference, I will use the normal rule, which I just did over here. If there is a difference, then I'd have used this information because this is based on actual information. So that is just what went through my mind, because remember, I was exposed to CTA. So for your purposes, you just follow your rule, okay? Follow whatever they told you in the example, and you can just follow this over here, okay? On a CTA 2 level, you're probably going to have to do this. On a CTA 2 level, you're probably going to have to do this check, because the reason is, why did it give me actual? Because remember, I'm coming now from having exposure to CTA and having exposure to the real world, where you're planning November, December, whatever. In the same way, some time ago, you planned October, but actual October may have been different. So the fact that they're giving me actual units produced, it kind of told me perhaps actual did not turn out to be as budget. So that is why I did both forms of calculations. Okay, so just so you to know, from a third year level, I don't think you need to do this check. Given the scenario, there was no need to do the check of working 2. You can simply do whatever you're doing over here. Okay, so we're happy with that. Any questions? This is the answer of, so this is the answer for part D or part C. Do you have any questions at this point? Kayla, Prashni, Kelsey, that's the names I can see on my screen. Okay, nothing from Kayla. I think I saw Bongani and Fahim. Any questions?
Oh, no questions, Faiz.
Okay. Bongani. Cool. Okay, so now we're going to go on to part C. Okay, so as you can see, part C was actually not, we're going to go on to part D. Part C was not too hard if you knew the format. Okay, so like I'm telling you, whenever you see budget's also going to be about sales and cost of sales. Generally, budget's going to be about sorry. So budget is going to be about sales and production. Okay, this is generally going to be the formula you're going to use for production. And remember, when you work out a proper production format, you're going to use this format. But remember, in a manufacturing business, there are 3 inventory items. This here is working with units, so generally working on a finished goods, right? But if they're working on rand values, then you're going to have a raw material. You're going to have a raw material set up exactly like this. Units sold, opening, closing. Obviously, in raw materials, you don't sell raw materials. Units sold is basically the units transferred to work in progress. Then you're going to have the same thing like this for work in progress. Once again, for work in progress, you don't have units sold. The units sold is basically the units transferred to finished goods. And then finished goods will look exactly like this. The only difference in work in progress, you won't just have one line item called production. You will obviously be split into raw materials, manufacturing overheads, direct labor, and so forth. Okay, so just be aware, this format always works, just may need some form of an adjustment. So now let's go on to part D. So part D you're having is basically a cash budget. Okay, so they want the same dates. Okay, so for part D, it's basically a cash budget. So a typical way to work out a cash budget would be basically as follows. Okay, so we'll have cash receipts. We can say cash receipts. And then you'll end up with total cash receipts or total cash inflows, doesn't matter. Or let's just actually do that. Let's rather call it in cash inflows. Then you'll have cash outflows. Then we'll have total cash outflows. And effectively you'll come to net cash flows. Okay, so effectively come to net cash flows. So bold. We probably don't need the net cash flows. I'm just giving you a fuller format because if they ask you for a full scenario, okay, this is not for a full scenario. This, what we have in this, the question required is not a full scenario, okay? But that is basically how you can set it up. Then you will list all the different cash inflows, so money coming in. You will list all the different payments going out, and then you compare cash inflows to cash outflows to see what is your net cash flow. Is it an inflow or is it an outflow? Okay. So obviously, if there's a negative, that means you're not making enough cash. So you have a shortfall. So then you need to make up money by borrowing or something of that nature. But we don't need the net cash flows. We just need cash receipts from sales and cash payments from suppliers. Okay, so let's have a look. So the required asked us as follows. Calculate the budgeted cash receipts and payments for the month of November, December, and January. Focus only on the sales and costs associated with the purchase of inventory. Okay, so just keep that in mind. So we know the units to be purchased. We just need to get the value that needs to be purchased. Okay, we know the units that needs to be purchased. We just need to get the value. Now they're telling us that EFH maintains an average product markup of 33%. Did I see the other thing? The company expects in the foreseeable future to maintain the existing average cost price per unit as indicated in the net current assets above. Okay, so now we can work out expected. The actual purchase price. Okay, so let's go and have a look. So I'm gonna have workings over here. Okay. So working one. Okay, so for working, what do I want working one? Yeah. So I want details. And I just want these ones over here. Okay, so we know production units. Okay, so we know, or purchase units, whatever you want to call it. Let's call it purchase units. Okay, so I'm going to go back to C. And I call it purchases. Okay. So purchase units is basically that over there. Okay, we're going to say this is from C. Okay, then we're going to say cost per unit. Cost per unit, and that's going to give us purchases in value. Purchases amount. Okay. Okay, so there we go. Now, the cost per unit, just to show you, I'm going to do it like this, working two. Inventory September 19. Okay. Units September 19. Okay. So inventory, it is 1533. 1 equal 1533. They said it's in rand million, so I'm multiplied by a million. 123, 123. Okay, and then it is 6132. And it is 6132, 123. Okay, so cost per unit would just be that. Okay, so cost per unit will simply be that divided by that. Okay, so 250, so cost per unit. Okay, so we're just going to say cost per unit remain consistent based on subnet current assets. How do we know that? Given in question. You don't have to write this. They will know what you're doing. I'm just telling you. So then it is working 2. So cost per unit is simply going to be 250. So purchase amount is going to be that multiplied by that. I should have done something else actually. Okay. You need October as well. Okay, so I was going to bring in October. Okay. Okay, here we go. So there's October. So we need October as well. Now we can go plug in. So remember, what did they say? They said that purchases is 50% in the, you pay 50% in the month of the purchase and 50% in next month. Okay, so let's have a look. The payments that we're going to make in November relates to, so the payments we're making in November relates to 50% of November sales and 50% of October sales. Okay, because remember, they said 50% is made in the month of purchase and the other 50% is made in the following month. So that means November's amount, 50% is paid in November, 50% is paid in October. Okay, so you're happy with that. So, I mean, in December. So November's purchases, 50% of this one of November's purchase amount is paid in November, and the other 50% is paid in the next month, which is December. Of December, December's amount, 50% is paid in 50% of December's amount is paid in December, and 50% is paid in January. For January, 50% is paid in January, and the other 50% is paid in February. Okay, so just take note of that. So what you can do, the easier way is to put it over here. November purchases, December purchases, and what's the other one? January purchases. Now, what do we know? 50% of November's purchase is made. 50% of November's purchase is made in November. Okay, you're happy with that? So I'm going to say that's November's purchases times 50%. Okay, make it negative is the payment. The other 50% is made in December. So then I'm just going to say equal the other 50% times 50%. Then we'll look at December. December's purchases. 50% of December's purchases is made in December. So I'm going to say equal negative. 50% of December's purchases is made in December. The other 50% is made in January. January's purchases, 50% is made in January. The other 50% is made in Feb, but Feb is not in our timeline. But now don't forget October. 50% of October's purchases was made in October. The other 50% is made in November. So there we go. Cash flows sorted. Cash outflows sorted. Do you have any question at this point before we go to sales?
No questions, thank you.
Now we're going to do cash inflows. So for cash inflows, there are 3 periods, okay? So in the month, okay, so it's in the month, and the month after. Okay, so what I'm going to do, so we're going to once again have November sales. Okay, I'm going to, November sales, December sales, and January sales. Once again, because some of the months fall into the next month. So let's say, so you can see we're paying inventory. We paid inventory over 2 months. Current month, next month. Similarly over here in the sales, we're paying current month, next month. So always one period in the next, what you call it. So that means if our period is running November to January, if our period is running from November, we must always have one period before, okay? Because remember, part of last month will fall into this month. If we had, let's say you pay 60% in the 60% in the current month, 28% in the next month, and the 9% in the following month. You can see it's running 2 months over. So your cash flows will have, what will fall into this period is 2 months before the beginning. So that means you're going to have October and September. So just remember that. So if your cash flows is running over 2 months, cash flows that's going to fall into your first month of your budget period will relate to 2 months prior. In this scenario, it only falls into 1 month after. So therefore, we will have cash flows falling in this month relating to 1 month prior. So just remember that rule. If it runs 3 months after, then cash flows falling in over here will have 3 months. Okay, so just be aware of that. So cash flow that will fall into this period will relate to 3 months prior. So that means before you have your current period's information, you're going to have 3 months before. So in this scenario, it only falls 1 month outside. So therefore, we'll have the 1 month prior. Okay, so let's deal with November's sales. So remember, let me just see what's happening here. Actually, it is 2 months. Okay, so it is actually 2 months. We're gonna need. What we're going to need? We're going to need September as well. Okay, so it is 2 months. Because remember, October's sales only get paid in November and December, because October's credit sales is invoice 31 October. So therefore, the 88%, the 60 and the 28 gets paid in November, which is 1 month after. And then the 9% gets paid in the following month, which is December. So as you can see, these are after the sales happen, 2 months later, sales gets paid. So just be aware of that. So therefore, we're going to have amounts relating to September and October falling into this November, January period. So just take note of that. But let's work out, let's deal with the current first. Then we deal with the prior. Okay, so we're going to need sales units. We're going to have sales price per unit. We're going to get sales value, okay, or sales amount. Okay, then we're going to say credit. We're going to say credit sales. Okay. Okay, so sales units. If we go back, sales units in September was 5253. Okay, 5253 123. Okay, so now we can just get the others. I'm just gonna go fetch it from C, I think. Okay, so there we go. Okay, so there we go. Now we can work out the sales. Now we can work out the sales price. So remember, what did they say? They said that there's a gross profit of 33%. Okay, so selling price okay, at 33% GP. So all we're going to do try to think quickly now. Cost would be selling price is 100, cost is GPB 33. Yeah. Okay. So I'll get my bearings straight quickly. So what do we know? We know the following. Okay, so what you must know that GP, they told us over here, is the following. They did tell us. EFH maintains an average product markup of 33% on selling price. When they say, so we know 33%, the markup is 33%. When they say it is on selling price, then selling price is 100%. If they say it's on cost price, and cost price is 100%. Okay, so just take note of that. So if they say it is on cost price, if the markup is on cost price gets the 100. If the markup is on sales, then sales get the 100. So remember, cost plus markup equals sales. So if the markup was on cost price would have gotten 100. So that means sales would be cost plus markup, which is 100 plus 33 would be 133. But when it's on sales, then sales get the 100. So that means markup is not 100, markup is something different. Because remember, cost plus markup must give me sales. So I have sales, I have the markup, so therefore this needs to be 100 minus 33, which gives me 66. Okay, so just take note of that. So what's important to take note is if the markup is on sales, sales get 100. If the markup is on cost, cost gets 100. Then you simply plug in the rest. So you're going to have the markup. You know whether it is on sales or whether it is on cost. If it's on cost, you plug in 100 over there. If it's on sales, you plug the 100 over there. And then the missing figure you work out. The missing figure is always cost plus markup gives me 100. Cost plus markup gives me sales. So then you'll be able to work it out from there. So because sales got 100, cost plus markup must give me 100. I know markup is 33, so cost must be 60. So that means I can work out the selling price. So the selling price would be, what do I want? I want the selling price divided by what do I have? When you take what you have, the have must be both rand and cost. So I have cost price that is in a rand value, and I have cost price that is in the percentage. So it is 100 divided by 67 multiplied by 250. So my cost price is 373. I mean, my selling price is 373. So now I can just basically plug that in over here. 373 so now I can work out my selling price, my sales value, sorry. And now I can work out credit sales. Okay, now I can work out credit sales, which is total sales times 75%. And now I can do the rest. Now remember, I always just start with the current period. Because once I get the current period right, my bearings will be more or less in check in my head. So then it's easier for me to deal with that the months outside of my current period. But like what I find with myself, if I start off with the stuff outside of my current, my brains go crazy. So I start off with the period inside of, I start with the months inside of my period. So that would then that just gets the bearings in my brain straight in terms of how the cash flows work. So now remember, my period is November, December, January. So I'll say of my credit sales, So for November's credit sales, what happens? November's credit sales, 88% is received in December, and 9% is received in January. So all I go do is the following. I say November's sales is received in December and January. So now I'm going to say November's sales is received in December. So November sales, credit sales, multiplied by what is received in December. So remember, November's credit sales is only invoiced on 30th November. Then 7 days later, I received 68%. That falls into December. And then, what was it? I think then 28% in that at the end of that month. So the end of the next month. So so basically, say in the first 7 days, 60%, and then 30 days later, from invoice date, which is still in November, it's another 20%. It's another 20%, 28%. Okay, so that I'll get. Let me just quickly go back to the scenario so you can see. So 60% within 7 days after the invoice date. Remember, invoice date 30th November. 28% by the end of the month after sales. The sales happened in November. So end of the month is December. So ultimately, the first two payments, the first 88% is in the month following. Okay, there's no time value of money, so it's fine. So what do we know? So if we go over there, so there we go. Okay, so in November, the last 9% is received in January. So multiplied by 9%. Okay. Then I say, okay, for December, now I'm going to deal with December's sales. Okay, so now I'm going to deal with December's sales. The credit sales of December, gets invoiced on 31 December. So then in the first 7 days after invoice date, which falls in January, I receive 60%. Then 1 month after the sales, so the sales happened in December, 1 month after that is January, I receive another 28%. So that means 88% of the sales I receive in January. The other 9% I receive in February, but February is not in our period. So therefore, I go for December sales. For December's sales, I'm going to receive 88% in January. Okay, for January sales, I receive nothing because I invoiced January on 31 January. I'm only going to receive it in February, so nothing for January. Now I can look at September and October. So let's go with September. September's credit sales was invoiced on 30th September, right? 88% is going to be received in October. October is not in our period. 9% is going to be received in November. Okay, so then I go September sales, I'm going to receive 9% in November. I think it's 9%, right? 88 plus 9, 97. October sales are invoiced in October. 88% is going to be received in November and 9% in December. They didn't ask us for net cash flows, but as you can see, net cash flows in November is negative, but then there's positives. Okay. That is the 15 marks. Let me just see if we answered the question. Just going to see if we answered the question quickly. Yeah, calculate cash receipts and payments. So there we did it. You don't need the net cash flow line item. I just put it there. That should be it. Okay, any questions? Oh, correct. We should add cash sales. So that's correct. You're right. Yes, thanks. Thanks. Kayla, I think. Was it? Kelsey, yeah. It's correct. Must add cash sales. Don't forget cash sales. That's also cash receipts, cash sales. Okay, so this is going to equal to cash sales happen in the month. So November's cash sales will happen in November. November's December's cash sales will happen in December. And January's cash sales will happen in January. Credit sales, cash sales. Yeah, so in an exam, start with cash sales. Most of the marks are going to be for credit sales. Start with cash sales because, as you can see, well, at least for me, the credit sales you can get stuck in. So like I forgot about cash sales. Okay, so that should be it. There we go. So everything is positive. So Scum is doing, at least seems to do well. Any questions from you guys? Let me just see. Fahim, Kayla, questions?
No questions.
Fahim, anything confusing your side? So if you have any questions, yes or no. If you do, ask a question. Otherwise, answer the next question. Is there anything still confusing from your side? So Fahim and Kayla?
Now I'm just gonna have to go work and revise this again.
Okay. Kayla?
There's no questions. Thank you.
Anything confusing?
Not really. I think maybe just the markup part. I think I did it wrong for the assignments.
I'll show you how to do the markup now. Kelsey?
I just have a question about the bad debt. Don't we add it because it's not a cash flow item?
No, we're not getting the
Okay.
money. We're not getting the money.
Okay.
No.
That's fine. Okay. That's all I wanted to know. Thank
Okay.
you.
Bongani?
I must redo the calculation because I made some mistakes. Now I can see that where is my
Okay.
problem.
Okay, but you know you're able to fix it going forward.
I will try. I'll try.
But I mean, like you can at least see your mistakes now. So when you practice now, from now till the exam, you should be able to rectify it.
Yes.
Okay. Prashni? Okay, no, I see you answered yes, so it's fine. Okay. So let me just show that that markup formula quickly. So when you want to do a markup, when you do a markup, whether it's accounting or whatever it is, okay, so when you want to do a markup formula, you basically have a rand column and you have a percentage column. Doesn't matter which way, okay? It doesn't matter which way. Whether it's percentage rand, rand percentage, doesn't matter. You'll have cost price, markup, and you're going to have selling price. Now, what you must know, cost plus markup gives you selling price. Cost plus markup gives you selling price. So cost plus markup give you selling price. So in this question, they tell us the markup is 33%. Okay, so the markup is 33%. The next you want to ask yourself, what is the markup on? Is the markup on selling or is the markup on cost price? If the markup is on cost price, we put 100 by cost price. So that means selling price is cost plus markup, which will give us that plus that, which will give us 133. That is why you'll see not a fact exams, they'll just have an if it's on cost, just 133 for selling price. Okay. But they never said it was on cost price. They said it was on selling price. Okay. So they said it was on selling price. So because it was on selling price gets the 100%. Now we know cost plus markup gives you selling. We have markup, we have cost. So to get, we have markup, we have selling. So that means we can work out the cost price. Because cost plus markup must give me selling. So X plus 33 gives me 100. X has to be 67. Okay, so that is basically it. Then you must see which of these numbers were given. So obviously the one you need to calculate will be not given. So in our scenario, selling price was the unknown. So selling price was the unknown. So selling price was the unknown. So one of these numbers must be given. Okay, so one of these numbers has to be given. So what was given, well, we could calculate it, was markup, cost price. Cost price we could calculate as 250. That's in effect given. So when the formula we use is basically what I want divided by what I have times what I have. Okay, so remember what I have needs to be both rand and percentage. So what do I have? In both rand and percentage, I have cost price. So I'm going to use cost prices information. If I had both for markup, then I would use markup. So what I have needs to be both in rand and percentage. So as you can see, I have both rand and percentage for cost price. So I'll use cost prices information. What do I want? I want selling price. Okay, so that is the unknown. That's going to be the answer. So I'll use selling prices, other known information. So what do I want? I want selling price. So I'll say equal to 100 divided by what I have, 67, and then multiply by what I have, which is the rand value, and that's what I'll work out. If it was other way around, if I just switch this to other way around, if this was 100, this becomes 133. Oh, I plugged it in. What I want divided by what I have times what I have. So you see, it makes a big difference in the pricing. So yeah, so that is basically how you do the markup calculation. Okay. Any questions? So that answers some of your question, Kayla.
Yes, thank you. I will always keep that in mind, the 100% on the cost price or
so
whatever they give.
So that's very important. Eh? So highlighting yellow is not part of the question. Okay. So that's all from my side. Any other questions you guys have that you may have? I'm not going to do I'm not going to do that financial analysis that you guys can do. Is there any questions from your side?
I know you are not going to do the financial analysis, but could you give us, I struggle with the reasons, or, you know, when they ask for commentary,
Okay.
and I know they're not asking for like, oh, you decreased in sales, or the cost of sales went up or something like that.
Okay, so I'll go quickly.
They want the scenario. Can you give us
Yes.
an example of how
Yes.
to answer that?
Okay. So they ask for interest-bearing debt ratio. So interest-bearing debt is basically interest-bearing debt over equity. So basically, whatever's in your WACC calculation, you're going to use in this formula. Okay, so whatever's in your WACC calculation, whichever source of finance you used in your WACC calculation is used over here. So whatever was debt divided by whatever is equity. Okay, so from the company's point of view. Okay, so whatever was classified as debt from the company's point of view divided by the equity. So just think here, and as you can see, they say use market value. So you take the numbers straight from your WACC calculation. Okay, so that is the interest-bearing debt. Calculate the following ratios for the year ended 30 September and provide practical ways the ratios can be improved. I cannot remember the information, but let's try our best. So what are we comparing to? Before you can even comment on the ratios, you need to first know what you're comparing to. So they said for the year ended 30 September 2019. So either some information must have been given that you can compare to. Okay, so that's the first thing you need to do. You need to pick up what information you can use compare. I cannot remember. Then we're going to have current ratio. Current ratio, current assets divided by current liabilities, return on equity, net profit divided by equity, price to book ratio. So price, share price divided by net asset value. Okay, so price to book ratio is share price divided by NAV. NAV is equity divided by number of shares. Okay, and then cash interest cover. So remember, interest cover is earnings before interest and tax divided by earnings before interest tax divided by interest. That's interest cover. They want cash interest cover, so it's going to be cash operating profit divided by interest. Okay, so that's how you're going to calculate. When you comment on a ratio, you can see there's 5 ratios, 1, 2, 3, 4, 5. Calculation gets 5 marks. So it's 1 mark per calculation. Comments gets 12 marks, right? Roughly 2 marks per calc. Okay, so roughly 2 marks per calc. You can see whichever one has a little bit more, required more bit thinking, will probably get the extra mark. Okay, so basically, or it's roughly 2.5 marks per question, 2 to 2.5 marks per comment. Okay, so the first thing you're going to have to do, practical ways you can improve the ratio. The difficult part over here is obviously whether it improved or deteriorated. So I guess they don't want you to state whether it improved or deteriorated. They want you to provide a way that it can be improved. So they're trying to tell you it's not at its best. How can we improve it? So if you have a look at interest to debt equity ratio, right? So they must likely have a target capital structure somewhere here. I don't know if they have a target capital structure. Do you know if they have a target capital structure? I can't remember. So the way you can improve the ratio is how do you reduce debt? Okay, that is one way you can improve the ratio. How do you reduce debt? Now, as you can see, the following you can see a lot of this information: cash, current ratio, interest bearing. That's all got to do with, by having less debt, you will have more cash flow. Okay, by having less debt, you will have more cash flow. Why? Because debt requires two forms of payment: interest and capital. So by having less debt, you can improve your cash flow. So ways you can improve an interest-bearing debt is somehow to reduce debt. How do you reduce debt? I'm gonna have to read the whole scenario again. I can't remember the scenario. So I have to read the whole scenario again to provide some information over there. With the current ratio, how can you improve the ratio? With so you can see they're having problems with controls and all of those type of stuff. So number one, the way they can improve the current ratio is by perhaps invoicing credit sales earlier so that they can get cash flows immediately, right? So you can see they're saying they get cash flows within 7 days of invoice. What if the invoice as and when the cash sales, as and when the credit sales happen? They invoice credit sales on 31 at the end of each month, and within 7 days they get 60%. What if they invoice credit sales immediately so they can get the payment within 7 days of the actual sale and not within 7 days of the invoice, which only happens at the end of the month? That's one way to improve the current ratio, because it reduces debtors. Okay, so it reduces debtors sooner, and it brings in cash flows sooner. Okay, that for me, that is one way that I can think of, just reading the working capital. Return on equity is net profit divided by equity. I don't recall a net profit figure anywhere. I don't recall a net profit figure anywhere. Was there a net profit given somewhere? I don't know if you remember. I can't remember. Okay, I can't now see, but basically, ways to improve. You want to improve profit. How do you improve profit? I'll have to have a look at that. How can you improve profit within the context of the scenario? I'm not 100% certain. Well, there is a way you can improve this. Remember, the smaller, it's not actually improvement, actually just a accounting gimmick where you reduce equity. If you reduce equity and profit remain the same, what would happen? It will go up. Okay, so basically that's how you can improve. So they're saying using market value. So the equity you're going to use over here is going to be market value. So how can you improve? Remember, return on equity is going to be net profit divided by equity. Because we're using market value, the chance of equity being, return on equity being high is very slim, because market value is obviously of the shares obviously going to increase, and as a result, your equity is increasing. The chance of you being able to increase profit at that rate is probably quite slim. So basically, you're going to have to probably, what you're going to have to do is you can suggest to them the way to improve return on equity is by either paying out a bigger dividend or by reducing the number of shares in line with its capital structure, perhaps buy back shares or something of that nature. Because if you buy back shares, the number of shares reduces, and if the number of shares reduces, share price times number of shares will give you, but this is like CTA level, so I don't want to tell you about that. Price to book ratio is to increase the share price, but how do you increase the share price? Is by, so remember, equity is hardly going to change, right? Equity is going to change by profits and dividends. So book ratio, the book part is net asset value. Net asset value is equity divided by number of shares. Okay, so that is net asset value per share. Price is the share price. So the only way you can improve that ratio is by either reducing equity. How do you reduce equity? By paying out a dividend, or increase the share price. How do you increase the share price? By producing better results than the market expects. So yeah, that's all I can think of. The cash to interest cover, the best way to improve this is to reduce interest. And the way you're going to reduce interest is by reducing debt. That is what I can think of. I'll have to, what I can do is, later on, I can't do it now, but later on, I'll read the scenario again, having this question in my mind, and then I'll think of answers, and I'll send you a voice note to the group, and then I will take you through it, one ratio at a time. Okay, would that work for you? Because obviously the information I gave was very general. It was very general with a little bit of context from what I can remember of the scenario. But yeah, so I will work through that, and then I'll provide you, I'll just read through the scenario again, having this context in mind, and then I'll send a voice note for each one of them and give a quick explanation. But it's basically just 2.5 marks. I want to see also whether if there is a way that you can compare to something. But if you can't compare, I guess they're trying to tell you they want the ratios to be improved. So remember, the only way you can improve the ratio is by impacting its denominator and impacting its numerator. So the way you look at it when you want to improve a ratio is or even comment on a ratio, is to have a look at the makeup of the ratio, the numerator, the denominator. All you do is you keep the one constant. So if you keep the numerator constant, then you ask yourself, okay, you need to so if you want to improve the ratio by keeping the numerator constant, you have to reduce the denominator. Then you ask yourself, how can you reduce the denominator? And you do the flip. You want to improve the ratio, you keep the denominator constant, and you want to improve through the numerator. The only way you can improve through the numerator is by increasing the numerator. Then you ask yourself, how can you increase the numerator? That will give you ways to provide you with a way to improve the ratio. And then also, and this is how management play around with ratios using financial accounting. So they will sit back and they'll say, okay, to improve, we can either affect the numerator or the denominator. Obviously, in the real world, they'll play with both. But just to get your thinking straight, is to keep the one constant and change the other. So if we keep the denominator constant, that means we can only change the numerator. The only way the ratio can improve through the numerator is if the numerator increases. Then you do the other side. If you want to improve through the denominator, we're keeping the numerator constant. So the only way you can improve through the denominator is by reducing the denominator. Just look at it mathematically. Now you say, okay, for the numerator, you want to increase the numerator. How can we increase the numerator? For the denominator, if you want to reduce the denominator, how can we reduce the denominator? That is how you look to improve the ratio. And you look at it in the context. And you look at it within the context of the scenario. That's also how you comment on a ratio in the real world. In the exam, you're not going to comment like that because it's too detailed. But if like an analyst, you will look at it at that level and you will just like break down it to the most granular level. And obviously, like for me, what I always look at is what is actually sustainable in what is a sustainable way that is actually not playing around with numbers, but actually really proper business, if I can put it that way. You understand? Because it's one thing to play around with a ratio, but it doesn't have a real business substance. So you always have to think about, is it really a business substance? So for example, like I told you over here, return on equity, pay out a dividend. But paying out a dividend, you're reducing equity. But is it really of substance, or are you just doing it to play around with numbers, or is it really something of substance? You know, things like that. So I'll have to look through the scenario again, and then I will get back to you. Okay, but basically, to comment on a ratio in the real world, so let's say you want to do investments, and let's say you have 1,000 rand you want to play around with. We just keep it for 1,000 rand for now. Obviously 1,000 rand is too little, but let's just say you have 1,000 rand to play around with. Instead of playing around with Bitcoin, because there's no fundamentals you can really understand from Bitcoin currently, or any crypto, instead of, so obviously with crypto, you stand a chance of losing everything or making good, depending on what Elon has to say. Okay, so if Elon says something great, you can make good money. If Elon says something not so great, you can lose all your money. Okay, so unless you really know how Elon's brain works, then go into crypto. But if you don't know Elon's brain, then probably don't go into crypto, because currently he has a good influence on crypto just by a few words on Twitter. So let's say you don't want to run that risk because you can't actually analyze Elon's brain. So let's look to a company. So on a basic level, because remember, whether you go into crypto or to business, into a shares, either way you stand a chance of losing. So why not put that 1,000 rand into shares, where if you're losing, at least you know you can still learn from it. You understand? Because now you can analyze a company on a very basic level. No need to analyze a company from on an analyst level, just basic for now, just to get you going. So like starting point to look into your ratios and break down the ratios in that level, understanding the numerator, denominator, and then what makes those stuff tick. What makes the numerator tick? What makes the denominator tick? So for example, with return on equity, what is the numerator? Net profit. What makes the net profit tick? Revenue minus expenses. So now you can break it down further. What are the core expenses and how do they actually make revenue? So when you spend time on revenue, what are the key drivers of revenue? And then when you spend on expenses, you look at the core expenses, what are the key drivers of the core expenses. And you just keep on going like that. That's how you can learn. So in the real world, that's how you would apply it. Yeah, not so hectic. Remember, for ratios, it's simply improve or deteriorate it, or increase or decrease, and then provide a reason within the context. This one is slightly different. They're telling you they wanted to improve. So provide practical ways that you can improve, not a textbook way of how you can improve. So I need to read the scenario and then I'll get back to you. Okay, that's fine. If you don't have any questions, you guys are good to go. If you have questions, you can ask me now. Okay, so no question. I just want to wish you well for your test. It's on Wednesday, I think, right? You're writing on Wednesday?
Yes.
So all the best for Wednesday. What time?
Around about 9.
9 o'clock. Online?
Yes.
Okay, so if it's online and you have practiced, if you have practiced with using Excel, then maybe use Excel, because it will save you time. What you can do, so you can have formats ready and all of those type of things. So so to say all the best for what you call it for your exam. Remember, go into the exam like Australia back in the days went into every cricket game. They won the game before the game started because they went in with a winning mentality. So when you go into your exam, go in with that winning mentality. Go in with a winning mindset. Go in with, I am passing. Don't go in negatively, because if you go in negatively, you're already on the back foot. So the moment something comes in the exam that you haven't covered, you are 10 steps back because you already went in negatively. But if you went in with positivity, you know you can do it. You have already you've passed some other third year courses. You've come through first year, you've come through second year. You writing this exam, you can do it. You're going to do it because you have done it before. You have put in all the prep work. So you go in with that winning mindset, knowing that you can do it and you have done it. And that before the exam, while you go through, you're practicing. Think of ways where you were thrown off and you made a comeback. So that is a proof that you can do it. So the question you need to ask yourself, and this is actually something from a psychology point of view. So you have that positive mindset. So typical books have a positive mindset of the following. The positive affirmation. I am great, I am this, I am that. So that is good. But one step better is to tell yourself why. So I'll give you an example where they relate, they use this example. So I think was a Pakistani girl, you know, that Malala girl, something like that. She's quite well known. Where she received, I think like her family was destroyed, whatever, then some random person like contacted her somehow, or she received a letter or something like that to say that I'm coming for you and I'm going to get you, right? So something like that was the story. I remember I was reading the article. And obviously she was nervous and scared or whatever, but then she composed herself and she told herself, when he does come, what am I going to do? And she told herself, when he does come, I'm going to kick him, hit him, and then run away, something like that. So what she did was, once she was done, I think she was done crying, but she realized crying and being scared is not going to solve the problem. So she told us, she made herself more positive, and instead of saying, I'm going to get away, she went one step further. Like, how am I going to get away? She told herself what she would do when he does come. And that's what she kind of, so they use that scenario, they use that example to tell like other people as well, obviously from a self-help. Now I'm using it here from an education point of view, that do the positive affirmations, but more and above that, because the positive affirmation does not give you a strategy to deal with when you come into a problem. So when you say, I am passing, yes, that's positive affirmation. But the question is asking, like, why do you know you are passing? If something does come on, what you're going to do. So just run through. So look to a past experience when you came across a question that was challenging. What did you do? Like I told you, I gave an example. I don't know who I gave an example. I think it was the CTA guys, where I gave an example to the CTA guys of when I came to the ITC exam and I struggled with certain, with there was two big questions I struggled with. I gave them an example of the ones and what I did. And I just reminded myself of certain things that helped me. Like in the one was an accounting question. When I read the question, I was like, this is like basically everything is the same. I couldn't see the difference. But then what ran through my mind was, I remember the accounts 3 lecturer always used to say, identify when you struggle or in accounting, always think about the accounting equation. So the accounting equation will help you with identifying whether you have an asset, equity, or liability. So then I'm like, okay, cool. Let's just do that. Identify what is this asset, equity, or liability. Clearly, it's a liability. And then I'm like, this is all liabilities. Why are they having 5 different scenarios with all liabilities, and they're asking me to discuss each one as all liabilities? Then I remembered him saying again, once you have identified the element, then classify the element in terms of the accounting standard. So if it's an asset, which asset? If it's a liability, which liability? Then I was like, but There's only two liability standards we covered: financial instruments and I-37, provisions and liabilities and so forth. But then it struck me, in the provision standard, there are different types of what you call it. And that's how I solved. So what was that I always remembered that when I get stuck on an accounting question I don't know, I'm going to go back to the accounting equation and go back to then identifying which standard it applies to. So I had a mechanism that when I get stuck, that's what I'll do. So something similar. What is it that you're going to do when you do get stuck? You're going in with a winning mentality. You're going in that you can do it, you am doing it, all of those type of stuff. But always, before you also go in, tell yourself why you're winning. Because you have won before. What made you won before? So you have some mechanism. So when you come across a question that you perhaps never came across, you told yourself you're winning, but you never had a strategy. But if you tell yourself why you're winning, you now do have a strategy. So when you do stuck, what is it that you would do? So just think about that. So like Malala, she didn't just say he's not going to get her. She also said why he's not going to get her. Because when he does come for her, she's going to kick him, hit him, and then run away. Yeah, I mean, it's something that basic, but she had something she's going to do. She didn't just say that he's not going to get her. Because what if he does come? She didn't have anything in her. She didn't have anything that she could have done if she just thought he's not going to get her. So she said she's not going to get him, but if he does come, what she's going to do, things like that. So so apply that. That is why when you study now and you get stuck, please don't do, the first thing must not be to go to the solution, because you are training your mind. When you get stuck, you're going to go to a solution. In an exam, there's no solution, or at least there shouldn't be one. So make sure you get that right. So remember, 50% is actual writing in the exam. The other 50% is over here. Okay, so it is not the brains, but the mental strength. Okay, and remember, basically the mental strength is how you condition yourself to be mentally strong, going in with a winning mindset. You are a winner. You're going to tell yourself, I am a winner. And you're going to tell yourself why you are a winner. There's various, doesn't have to be education only. It can be other stuff as well that made you a winner in the past when you overcame an obstacle. Remember, the true winners are the ones that overcome obstacles, not the one that have an easy road. So just remind yourself, have that positivity. So when you're going to the exam, don't go in nervous. Go in with that winning mentality, that positivity, and remind yourself that you have done your best. You didn't sit back and you didn't sit back like from today till Wednesday. You're not sitting back and saying, I'm a winner, I'm a winner, I'm a winner, and you're doing absolutely nothing. You're telling yourself you're a winner, why you're a winner, and you're putting in. And winners put in the effort, and you are putting in the effort. So by the time the exam comes, the effort has been put in, and you are a winner, you are winning, and that should be good enough. Okay, remember, but remind yourself of a point of when you won, what made you overcome. That is going to make the mental strength even stronger. Like I don't know if you watch cricket. Back in the days with, not back in the days, I mean, at least when Hashim Amla and Faf du Plessis and JP Duminy and AB de Villiers, when they played test cricket, I don't even remember. There was many times where in test cricket, so you play over 5 days, the game literally go up and down, up and down, up and down. Then we always in a place where basically the game is lost. And we need to bat for how many days. And then Faf, AB, and Abla can bat like for 2 to 3 days and then turn a losing situation into a winning situation. They did it once, and then when it happened again, they knew they can do it again. Why? They went in, they were mentally strong firstly. Amla and de Villiers and whatever were known to have that capacity to bat with full concentration. People can chirp around them and they don't even know because they're in the zone, right? But what what made it even more stronger was they knew they did it before. Then the third time it happened, they knew they did it twice before. Then the fourth time it happened, they knew they did it 3 times before. Then the fifth time happened, they knew they did it 5 times before. So that is, they had the mental strength, but they also reminded themselves that they've done it before, and they will tell themselves how they did it before. So the same thing, there must have been situations where you came across something and you overcame it. Remind yourself of that. Okay, so don't forget the mental capacity, the mental strength is positive, needs to be positive. Don't go in there with that. You don't go in with the mentality that MAC3. So for the repeat, guys, don't go in there with I failed it twice, I failed it once, it's gonna hit me again. I'm not good at MAC3702. MAC3702 is too difficult. If you're doing that, you're giving MAC3702 the hold over you. You want to have it by the neck. So go into the exam with you having it by the neck, so that in the end, even though at the end of the exam you don't exactly have it by the neck, but you still have the grip. So just make sure, go in that you can do it. It is not as hard as you think it is. Okay, so please have that positive attitude when you go into the exam. So once again, all the best. Remember, you are a winner. If you need motivation, so most of you here are ECP. So that means it's probably just this one course you need to write, or you just need 2 courses to make it, right? To pass. Think about when the results come out, how you're going to feel when you pass. Think about it. So when you need motivation during this period, think about the result when you need to pass. That will alone push you. And then remind yourself that you have to put in the effort down to have that feeling. Like one of the things I had in the exam, I was telling my CTS guys that when ITC exam, you write over 2 days, 2 papers per day. Session 1, session 2. In day 2 of session 2, so the last paper, I went into the paper and I was like, okay, the past 3, I most likely passed it, but I just passed it. If I didn't pass it, I just failed it. I felt okay with the past 3. I never shot the lights out, definitely not getting more than 60%. Doubt I got more than 55%, but I'm pretty sure I'm at least getting that 50%, between 50-55. If not, I just failed. So, or I didn't use the word fail, I just didn't make it. So all I need is this paper, this last paper, to be exactly the same. I just needed to be in that region of either pass, or if I didn't pass, I just didn't make it. Because if I'm in that range for all 4, ITCs in the bag. Okay, but then that 4th paper came and I didn't know what was happening. Right, like it was a 20 marker accounting, 80 marker MAC. At that time, I wasn't good at MAC. I loved MAC. But at that time, MAC was one of the courses that almost cost me CTA. So I wasn't great at MAC, but I loved MAC, right? So 80 marker MAC, I was reading the scenario, like, okay, cool, it's definitely MAC, but I have no idea what is happening over here. So I read it, finish. Go to the 20 markers, like, cool, 20 marks accounting. I see the question, and I was like, yes, 20 out of 20 for me. Because this question we did like 3 times in the lecture at UCT, like he did like 3 times with us. And like I knew it inside out. Basically the answer was in the IFRS text, in the IFRS handbook. The answer is right there. I open up the book so long, because remember you get the scenario first, then you get the required. So you have like 30 minutes to read or something like that. So I open up IFRS, I'm like reading it. I already answered on my reading paper, like 20 out of 20 for me. Great. Required comes. So I read the required quickly for MAC. I'm like, okay, cool. I still don't know what's happening in MAC. So I go to accounting. I'm like, I'm gonna start with accounting. I'm gonna get 20 out of 20. When I open up that paper to the required for part 2, what I thought I would get 20 out of 20 was only 5 marks. And I'm like, okay, cool. I'll get 5 out of 5, definitely. But I'm still 15 marks different. Look, what's other 15 marks? Other 15 marks is earnings per share. I didn't study earnings per share, so I was hoping it's not going to come in. So earnings per share is like, oh, oh shucks, 15 marks, I don't know. 80 marks, I also don't know. I'm in a panic now, but I was good at keeping myself calm, good at keeping myself composing myself. So now I'm like, what do I do? So I'm like, okay, you know what I'm going to do? Earnings per share, all the answers of earnings per share, all the types of scenarios relating to earnings per share is found in the IFRS book. It might not be in the exact format, but somehow if you look around. So what I did was I paged through earnings per share. I go through the illustrative examples. I'm like, okay, I need this one, this one, this one, whatever it was. Okay, so I had all of it, and I basically sitting with IFRS, and I'm writing, copying down, just changing the numbers. Okay, but obviously the setup is slightly different because not exactly the scenarios given in IFRS may not be exact scenario in what you call it, but every possible scenario is in the IFRS handbook. So I did it. Cool. Came to a certain point, I'm like, okay, you know what? I just assumed the answer and I moved on. Okay, so I'm like, okay, cool. Probably got like something over there, but I definitely passed that. So I overcame it, but it took a bit longer because I was basically copying IFRS. I didn't know what I was doing, so I had to. So obviously it did much longer than I should have taken. Now I need to deal with the 80 marks. I can't just leave that 20 marks, not enough. Because I probably got like 10 out of 20. There's not enough to pass the paper. I try to do the 80 markers, I still don't. I tell myself the question. I can get up now and leave, then I'm done. Or I can stay. What do? I tell myself, if I get up, I'm guaranteed 0. I'm guaranteed 0%. Right? I'm guaranteed 0% because there's nothing on my paper. Not for that 80 marker. There's nothing on the question 1. So if I get up now, I'm guaranteed 0. The alternative is I have a whole, I don't know, I can't remember, 2 hours, 1.5 hours. If I write something, I can get some marks. Then I think the big question was either 20 out of the 80 markers, the big box was either 20 marker or 40 marker. I can't remember. So let's just say it was 20 marks. Okay, then I told myself, okay, to get that 20 marks, it was a discussion question. So I'm like, okay, to pass that, I think it was 40 marks. So let's just go with the 40 marks. So I said to pass that 40 marks, I don't need 40 out of 40 because that's 100%. I basically need 20 out of 40. That is to get 50% for that part. But I said, I don't actually need 40%. I don't need 50% because you just need basically 40%, and then you fall in the okay zone. So I don't need 20 out of 40. I actually need 16 out of 40. Okay, so I'm like, that's doable. But this was the trick. I reminded myself that any discussion question of a psych exam, if the marks is 40, the available marks is 80. It's always like double. So I said, in effect, I don't need 16 out of 40. I need 16 out of 80. To get 16 out of 80 marks, surely I can do this. And that is where the light switched. But I'm still nervous. I don't know. So I'm like, okay, you know what? I can't like answer this. So I need to just be calm. Or what I did was, I went to go sleep for 20. I told myself I'm going to go lay for 15, 20 minutes. After 15 to 20 minutes, I should be calm and the time should be compressed. When the time is compressed, I work well under pressure. So when the time is compressed, I'm going to be under pressure and I'm going to be calm. And that's going to kick in me to just, somehow I'm just going to be able to answer. And that's what I did. So I'm going to go lay for 15 to 20 minutes. Obviously that time you're going to prayer mode. So in that 15 to 20 minutes, I wasn't like sleeping, obviously. I was closing my eyes, calming in whatever prayers you need to do. And what made it worse for me is that sitting next to me was the girl that studied with me at UCT that came in the top 5. I think she came either 5th or 3rd. And she's like motoring here next to me. So I was like, obviously, but what I did was I was like, I'm not going to let that, she's a top. She came in top 3, certainly she knows her stuff. So I'm not going to let her motoring next to me bog me down. Okay, so I just went to go lay down. And it was a mechanism I used to get me back into the zone. I knew I needed to be calm. I knew I needed to be under pressure. So I did those two things, calm myself down, 15 to 20 minutes just laying, okay? Obviously like praying, whatever. And then the other thing was that suppressed time. The less time I have, the more under pressure I'm going to be. But obviously I gave me enough time. I didn't like say, okay, to do a 1 hour question, I'm going to do it in 30 minutes. It's like I suppressed it, that it's tight, so that I could answer, and I finished what I could answer to the fullest. I didn't answer everything, but what I could answer, I basically didn't run out of time. I had 5 minutes to spare. So when I say 5 minutes to spare, it doesn't mean I answered 100% of the paper, but I answered 100% of what I could answer. And for me, that is like I found what you call it, I ran through scenarios through my mind. Like I said, leave now or stay. If I leave, definitely 0. If I stay, there's a possibility. So I'm like, okay, now if I stay, what do I do? So just finding something to zone in. So remember, and what made me stay was the following. I want to pass ITC. That is what made me stay. If I leave now, definitely 0. The chance of me passing is slim. Do I want to come back in June? The pass rate of June is lower because most of June people are repeats, and the repeat rate is based on stats very low. So I want to pass. So that's what I want to do. So if I stay, I have the chance of passing. So that is what you want to do. So when you come to when you're stuck, you've already trained yourself of something that you can do to overcome an obstacle. And the motivation is when the result come out, you want it to be passed so you can graduate. Use all of those. As you can see, nothing of what made me go through was content related. It was a mechanism, something I used to actually get through. So remember, it's not just about your skill, your talent, and so forth. It is also about your ability to be composed, be calm, and have something like having that winning mentality. I didn't have a winning mentality then, but like now I can tell you, have that winning mentality. Okay, so like I said, I'm gonna stop now. Once again, all the best. Just push for this last few days. Not just content related, but train your brain to be mentally strong. Spend some time to sit back and just think about the content. Without doing it, think about the content. What are the issues? What did I learn? What was my mistakes? Have I fixed it? How did I fix it? The key issues, what are all the key issues? Run it through your brain. Run a formula through your brain. If I do whack, I do it like this. I have all of these options. These are how I calculate it. I'm just thinking about it. That is what you want to do. So get to that point. Okay, take some time to sit back and just think. Okay, so I'm going to stop here. Do you have any questions? If no, we are good to go. Okay, any questions? No? Okay then, goodbye guys, and all the best.